If you're one of the millions of people who bought crypto for the first time in 2021, you might be in for a surprise when you do your taxes. Crypto may have started out as a discrete decentralized economy, but now that the nearly $2 trillion sector has gone mainstream enough to occupy coveted Super Bowl ad space, the Internal Revenue Service is well clued in. The IRS classifies cryptocurrency as intangible property for tax purposes, which means the profits you make from selling virtual currency are subject to capital gains taxes. This holds true whether you bought Bitcoin or altcoins on a crypto exchange like Coinbase, or simply used an app like PayPal to buy and use cryptocurrency. Here are some common surprise crypto taxes and how experts suggest you stay prepared. Gifted crypto and airdrops. Crypto was a popular present last year. According to a BlockFi survey, 1 in 10 people gave crypto as a holiday gift. However exciting crypto may be, if someone gave it as a gift, they should be aware of IRS rules on gifting. There's a $15,000 gift threshold for 2021, meaning the giver doesn't have to pay taxes on the gift as long as it's worth $14,999 or less. The only donor of a gift is responsible for associated tax reporting. If the value of the gift is over $15,000, the tax burden falls on the generous donor, who must file IRS Form 709. But there are some nuances. If someone is given crypto and it gains value and they experience a capital gain when they sell it, either for US dollars or a different cryptocurrency, they'll be required to pay capital gains taxes on the amount they profited, not the entire amount they sold it for. Capital gains taxes are also calculated based on their income and how long they held the asset before selling. NFTs. Anyone on social media has likely heard of non-fungible tokens by now, but few know how they are taxed. The IRS has yet to release definitive guidance on NFTs, but it's worth noting that British tax authorities recently made the country's first seizure of NFTs during a fraud investigation and tax crackdown. Until the IRS issues more nuanced guidance, tax professionals advise treating NFTs as virtual assets just like any other crypto. Buying everyday goods with crypto. Buying goods and services with crypto, even small purchases like buying a coffee, might trigger a taxable event in the eyes of the IRS. Here's why: paying for everyday items involves exchanging a digital currency for fiat currency. Prepaid crypto debit cards and crypto credit cards make this process so seamless it may not seem like it's worth telling the IRS. However, small transactions throughout the year can add up to a significant sum. So, do you think cryptocurrencies will be accepted throughout the world soon now that the governments are implying taxes on them? Next time we'll talk about Axie Infinity, a game universe filled with fascinating creatures, Axies, that players can collect as pets. Follow us on Twitter to stay up to date. To learn more, check the links in the description.